My stock market portfolio is built around a clear and deliberate philosophy that prioritizes long-term wealth creation supported by disciplined risk management rather than short-term speculation or emotional decision making, because I believe sustainable financial success comes from patience, consistency, and sound judgment applied over time. At the core of my approach is a strong emphasis on investing in high quality businesses with robust fundamentals, meaning companies that demonstrate healthy balance sheets, reliable earnings growth, prudent capital allocation, and management teams with a proven track record of acting in shareholders' best interests. I actively seek businesses that possess durable competitive advantages, often referred to as economic moats, such as strong brand recognition, pricing power, network effects, cost leadership, or regulatory barriers, as these factors help protect profitability and market position across different economic cycles. Consistent and predictable cash flows are another critical pillar of my strategy, as they provide resilience during market downturns, support reinvestment for future growth, and often allow companies to return value to shareholders through dividends or buybacks. Rather than chasing short-term market hype, speculative trends, or momentum-driven rallies, I consciously avoid decisions based on noise, headlines, or fear of missing out, recognizing that such behavior often leads to poor risk-reward outcomes and unnecessary volatility. My objective is steady compounding over time, where incremental gains, when allowed to grow uninterrupted, can produce meaningful wealth in the long run, and this requires a mindset that values time in the market over timing the market. Risk management plays a central role in my portfolio construction, and I address it through diversification across sectors and business models, careful position sizing, and a continuous assessment of downside risks alongside potential returns. I balance growth-oriented investments with more stable, cash-generating holdings to ensure that the portfolio can participate in upside opportunities while maintaining a margin of safety during periods of uncertainty or economic stress. Valuation discipline is also essential to my process, as even the best businesses can become poor investments if purchased at excessive prices, so I aim to invest when there is a reasonable alignment between price and intrinsic value. I regularly review my holdings to ensure that the original investment thesis remains intact, but I avoid excessive trading, as high turnover often erodes returns through costs and poor timing decisions. Emotional control is a key part of my philosophy, as market volatility is inevitable, and I view periods of decline not as threats, but as opportunities to reassess fundamentals and potentially add to high-quality positions at more attractive valuations. Ultimately, my portfolio is designed to reflect a balance between ambition and prudence, seeking meaningful growth while prioritizing capital preservation, because I understand that wealth creation is a marathon, not a sprint, and that consistent adherence to a well-defined strategy is far more powerful than reacting to short-term market fluctuations or attempting to predict the next big trend. The core of my portfolio is intentionally constructed around a collection of high-quality stocks spread across a wide range of diversified sectors, including technology, financials, consumer goods, and energy, because I believe true portfolio strength comes from balance rather than dependence on any single theme, industry, or market cycle. By allocating capital across multiple sectors, I aim to reduce overall volatility while still maintaining meaningful exposure to businesses that can deliver strong long-term growth, even as economic conditions evolve. The technology segment provides access to innovation-driven companies that benefit from digital transformation, automation, cloud computing, and scalable business models, offering the potential for outsized returns over time. Financials add stability and cash flow consistency as well. Managed banks, insurance companies, and financial service providers tend to benefit from economic expansion, rising financial activity, and disciplined risk practices, while also offering dividends and balance sheet strength that can anchor the portfolio during uncertain periods. Consumer goods holdings play a defensive yet essential role, as companies supplying everyday necessities or trusted brands often demonstrate resilient demand, pricing power, and steady earnings regardless of broader market fluctuations, helping smooth returns when growth-oriented sectors face pressure. Energy investments provide diversification through exposure to real assets and global demand dynamics, offering both income potential and a hedge against inflation, while also capturing opportunities arising from shifts in energy production, efficiency, and long-term structural changes within the sector. This multi-sector approach allows the portfolio to benefit from different economic drivers at different times, ensuring that weakness in one area can be offset by strength in another, rather than allowing performance to hinge on a single macro narrative. Diversification, however, is not pursued blindly. Every holding is selected based on quality, fundamentals, and long-term viability, ensuring that capital is allocated only to businesses with sustainable competitive advantages, sound financials, and capable management. Equally important to sector diversification is position sizing, which I treat as a core risk management tool rather than a secondary consideration. Each position is sized carefully to avoid over-concentration in any single stock or sector, recognizing that even the strongest companies can face unexpected challenges due to regulatory changes, competitive threats, or shifts in consumer behavior. By limiting the weight of individual holdings, I protect the portfolio from disproportionate losses while preserving the flexibility to adjust allocations as opportunities emerge. This disciplined sizing approach also encourages rational decision making, preventing emotional attachment to individual stocks and reinforcing a rules-based investment process. I regularly evaluate correlations between holdings to ensure that diversification is effective not just on the surface, but in practice, particularly during periods of market stress when correlations can rise unexpectedly. The goal is not to eliminate risk, which is impossible in equity investing, but to manage it intelligently, ensuring that no single mistake or adverse event can significantly derail long-term progress. Through this structured combination of sector diversification, quality selection, and prudent position sizing, my portfolio is designed to participate in high growth opportunities while maintaining resilience, adaptability, and capital protection, allowing compounding to work steadily over time without exposing the overall strategy to unnecessary or avoidable risk. Risk management is a central pillar of every investment decision I make, shaping not only what I invest in, but how I allocate capital, monitor performance, and respond to changing market conditions, because I understand that protecting capital is just as important as growing it over the long term. Rather than viewing risk as something to be avoided entirely, I treat it as a factor to be measured, understood, and controlled through a structured and disciplined process that is applied consistently across my portfolio. I regularly review company earnings to ensure that revenue growth, margins, and cash flows remain aligned with the original investment thesis, paying close attention to signs of operational strength or weakness that could affect long-term prospects. Valuations are also monitored closely, as shifts in price relative to fundamentals can significantly alter the risk-reward balance of a holding, and even strong businesses can become vulnerable investments if expectations become too optimistic or detached from underlying performance. Alongside company-specific analysis, I track broader market trends, including macroeconomic indicators, interest rate movements, sector rotations, and changes in investor sentiment to better understand the external forces that may influence portfolio performance and risk exposure. These reviews are not conducted with the intent of frequent trading or reacting to short-term noise, but rather to confirm that each holding continues to fit within my overall strategy and risk parameters. When a stock no longer meets my criteria due to deteriorating fundamentals, excessive valuation, or a structural change in its business outlook, I am willing to reduce or exit the position in order to preserve capital and reallocate resources more effectively. At the same time, I avoid impulsive decisions during periods of market volatility, recognizing that temporary price fluctuations do not always reflect changes in intrinsic value and that emotional reactions often increase risk rather than reduce it. An important component of my risk management approach is maintaining a portion of the portfolio in a flexible or liquid form, which provides both defensive stability and strategic optionality. This flexibility allows me to respond thoughtfully to new opportunities that arise during market dislocations, corrections, or periods of heightened uncertainty, when high-quality assets may become available at attractive valuations. It also gives me the ability to adjust existing positions as relative risks and returns evolve, without being forced to sell long-term holdings at unfavorable prices simply to raise capital. By preserving this adaptive capacity, I ensure that my portfolio remains dynamic and resilient rather than rigid and reactive. I also consider diversification, position sizing, and correlation between holdings as ongoing risk factors, continuously assessing whether the portfolio is appropriately balanced across sectors, market capitalizations, and economic sensitivities. The goal is to avoid concentration risks that could amplify losses during adverse conditions, while still allowing sufficient exposure to long-term growth drivers. Over time, this disciplined risk management framework helps reduce drawdowns, smooth returns, and reinforce consistency, which I believe are essential ingredients for successful compounding. Ultimately, my approach reflects the belief that long-term investment success is not achieved by avoiding uncertainty, but by preparing for it through continuous evaluation, thoughtful flexibility, and a clear understanding of how each decision fits within a broader, well-defined strategy designed to endure across different market environments. I continuously track my portfolio's performance with a focus on long-term benchmarks rather than reacting to daily price movements, because I recognize that the true measure of investment success is not short-term fluctuations, but the consistent ability to generate compounding returns over extended periods, and monitoring performance in this way helps me maintain perspective, discipline, and a clear understanding of whether my strategy is working as intended. By comparing results against carefully chosen benchmarks, I can evaluate the effectiveness of my investment decisions in a meaningful context, identifying whether each holding is contributing appropriately to long-term growth while still adhering to my risk management principles, rather than becoming distracted or swayed by market noise or temporary volatility that can often lead to impulsive and counterproductive behavior. Wins and losses are both valuable sources of insight, as each outcome, whether a stock outperforms expectations or underperforms due to unforeseen challenges, provides a practical opportunity to analyze what went right, what could have been anticipated more effectively, and how the lessons learned can be applied to future investment decisions. I approach losses with the mindset that they are not failures, but signals that allow me to refine my strategy, adjust my analytical frameworks, and strengthen my decision-making process, while wins are treated as confirmations of sound principles, reinforcing behaviors that align with my overarching philosophy of disciplined, long-term wealth creation. This reflective and iterative approach helps me avoid repeating mistakes and ensures that each experience contributes constructively to the evolution of my investment methodology. Looking ahead, I plan to maintain patience as a core element of my approach, recognizing that market cycles naturally include periods of volatility, uncertainty, and temporary declines, all of which are normal aspects of the investment landscape and often present opportunities rather than threats when approached with a long-term mindset. Sticking to my rules that are designed to prioritize quality, valuation discipline, diversification, and risk management, remains essential as these guardrails prevent impulsive decisions and help preserve capital during periods of market turbulence, while also providing a framework for identifying when attractive opportunities arise. I view market volatility not as a reason for anxiety, but as a chance to strengthen the portfolio by reallocating capital toward high-quality businesses that may be temporarily undervalued or overlooked by other investors, allowing me to take advantage of dislocations in a manner consistent with my philosophy rather than reacting emotionally. This approach requires patience, discipline, and a willingness to act counter cyclically, resisting the temptation to follow the crowd or chase short-term trends, and instead focusing on the underlying fundamentals and intrinsic value of each investment. I also recognize that long-term success depends on consistency and compounding, and that repeated adherence to a clear and rational process will ultimately produce results far more meaningful than sporadic gains from speculative trades or market timing. By maintaining a continuous feedback loop of assessment, reflection, and disciplined execution, I am able to keep my portfolio aligned with my strategic objectives while adapting intelligently to changing conditions without compromising the principles that drive sustainable growth. Over time, this combination of patience, adherence to well-defined rules, thoughtful learning from both successes and setbacks, and strategic use of market volatility is designed to create a resilient and steadily growing portfolio that can endure economic cycles, capitalize on opportunities, and maximize the long-term compounding of wealth, demonstrating that disciplined investing guided by reflection, process, and patience ultimately outweighs short-term reactions and emotional decision making in achieving lasting financial success.